All right. So welcome once again to this edition of TaxBridge Initiatives webinar. This is webinar 2.0. We hosted webinar 1.0 in June, and I believe a couple of us here were present at the last edition. So this is webinar 2.0. Thank you once again for joining us this evening, this Saturday evening. You could have been anywhere else, but you chose to be here. So we really appreciate your presence. The topic for this webinar is demystifying value-added tax in Nigeria and elevating your tax career. My name is Chizoba Ngudo. I am the host and founder of this initiative. So for this evening, we will be having two speakers, two powerful tax professionals that will be addressing us this evening. And the first speaker, his name is Abdulwahab Yunusa. He'll be speaking on VAT fundamentals, compliance, and filing on TaxPro Max. Everything you need to know. Wahab will be addressing it. And then our second speaker is a lady. Her name is Titilope Ariyo. I hope I pronounced that correctly. So Titilope will be speaking on climbing the corporate ladder as a tax professional. She's going to be giving us all the tips, everything we need to know to climb that ladder as a tax professional. So before I hand over the mic to Wahab, let me just do a brief introduction. Abdulwahab is a seasoned tax professional. He has vast experience in audit, tax, accounting, name it, anything generally as an accountant. Abdulwahab is well knowledgeable, trust me. Another fun fact, Abdulwahab and I used to be colleagues, like we used to work together. And presently he's a senior tax officer at CIG Motors. So right about now, I'll be handing over the mic to Abdulwahab to commence his session. But I would like to see your reactions, your clapping emojis. Let me just know that you're following me. Thank you. You guys are not reacting. No. Should I tell him to hold on? So thank you so much, Abdulwahab. Please, you have the floor. You can share your screen.
Yeah.
Good evening, everyone. Good evening, Chizoba. Can anybody hear me? Am I audible?
Loud and clear.
Okay, thank you for the introduction. And I'm actually glad to be here today. So permit me to share my screen quickly.
All right.
Sorry, I can't hear anything again. Hope everything is well.
Yes, everything is fine. We are trying to share. He's trying to share his screen so that we can comment.
All right, thank you.
Okay, thank you. Can you see my screen now?
Yes, I can see.
Okay, thank you. So once again, my name is Yunusa Abdulwahab. I'm also a tax professional as well as an accountant with a few years of good experience. So basically today, I will be taking you guys through the basic understanding or consent of VAT in Nigeria, as well as the compliance, as well as any other emerging reforms, which we might also opt to know. Then basically this is the content. So we'll go through the introduction, the meaning of VAT in Nigeria, scope and administration, as well as key items, key terms and concepts, and taxable goods and services, down to key takeaways and conclusions. So, introduction to VAT, value tax. So, what is VAT? So, basically, VAT is a consumption tax paid when goods are purchased or services are rendered. So, essentially, VAT is being charged on when we make purchases or when we make sales, virtually almost everything, except from those items on the first schedule of the VAT Act, which are actually exempted or zero rated when it comes to VAT. So again, VAT is also a multi-stage tax, but borne by the final consumer. What do I mean by this? At every stage of the product life cycle, either you are paying VAT or you are collecting VAT. So what do I mean? Starting from the manufacturers and the distributors down to the final consumer, is a process of VAT collections across all those stages. So take for instance, starting from the manufacturers, the raw materials they are going to use in producing their goods at the end of the day, they will suffer what we call the input VAT on those raw materials. So at the point of them selling either to the wholesale or the final consumers, they in turn will also charge what we call the output VAT, which is actually charged when you are actually making sales on goods and services. So when the wholesales or the retailers also receive these goods, of course, when they are buying from the manufacturers, they have also incurred what we call the input VAT for making purchases. And then when they are also selling to the final consumers, they will also charge VAT on such sales. So when you see it, so the VAT is actually a multi-stage thing, in the sense that it starts from the manufacturer at the point of you purchasing the raw materials down to the final consumers who finally borne the tax burden. So VAT applies to all goods and services. So virtually all goods and services, whether locally or imported into Nigeria, aside from those specifically exempted. So VAT has actually been around since 1993, replacing the sales tax, and several amendments have actually been made to this act, down to the most recent, which is the VAT modification order in 2024, which I'm actually not for now probably considering the Nigeria Tax Act probably till next year when it becomes effective, and probably whichever changes it may also bring. Then moving forward, so pretty much the scopes and administration of VAT in Nigeria, basically, like I said before, VAT is being charged on taxable goods and services in Nigeria. Then the Federal Inland Revenue Service are actually responsible for the assessment, collection, as well as remittance of VAT. Then aside from that, the VAT is currently at 7.5. Even when we also kickstart the new tax law, which is the Nigeria Tax Act, the VAT still remains at 7.5 as we speak. Then taxable goods and services. So what do we mean by taxable goods and services? We simply are talking about services, goods that are eligible to VAT payment. So basically, all services and goods are eligible to VAT payment, aside from those specifically stated on the first schedule of the Act as VAT exemptions. Then, and again, what are the conditions for a transaction to be made, or for a services or supply of goods to be made before we can say, okay, this particular transaction or item should be accessible to VAT. So I'll be starting with the goods. So number one, such goods should be physically present in Nigeria at the point of supply for us to be able to assess VAT on these transactions. So take for instance, we at CIG Motors. So basically, part of our core business is we are into business of sales of cars, branded new cars. So we sell GAC and some other brands in our own in our company, in our organization. So when such goods are physically present in Nigeria, so such goods should be what are accessible to VAT. Then what are other conditions? Goods imported, assembled, or installed in Nigeria as well. So some of our cars are actually brought into Nigeria semi-knocked down or fully composed car. So whichever way, in as much as they are imported in Nigeria, assembled or installed, and this sold in Nigeria, they're also accessible to VAT. It's not just only on the automobile industry. Speak on any other industries in Nigeria, it also still applies to it. Then right over goods held by a Nigeria taxable person. So now there are some specific goods that are patent rights or lease or those agreements that a taxable person in Nigeria has a right over or has ownership over. Such goods are also what tax taxable in Nigeria. So when we also comes to the service aspect, service supplies to Nigeria residents regardless of where it is performed. So essentially, if I'm in Nigeria and a US-based software developer is actually developing the software for my company, solution for my company, then in as much as I'm in Nigeria, I'm actually consuming such services in Nigeria, and such service is actually what exposed to what VAT. Also, Nigeria to Nigeria. So whichever way, in as much as the recipient of such service or the consumer of such service is based in Nigeria, then such service is actually what VATable. Then services connected with immovable properties located in Nigeria. So we have some services in Nigeria, just like the oil and gas industry. Probably there are some specific properties or equipment that needs maintenance and management. We might need a foreign expatriate to maintain and the likes. So in as much as such properties is in Nigeria and the maintenance and services needed to be done on it, should be done in Nigeria. So such services are also what expected to be what VAT. Then incorporate assets. So these are what intangible assets when it comes to patent rights, licenses, and technologies. So rights exploited by Nigeria persons. So take for instance, those using Sage 50s, QuickBooks, and the likes in Nigeria. These are what intangible assets. In as much as you exploit, consume these services or these assets in Nigeria, then such services are what also what VATable. So essentially, what we're trying to say, any consumptions in Nigeria, irrespective of where such service or goods have been supplied, they are actually what VATable. So I don't know if anybody can hear me or.
We can hear you.
Okay, thank you. Then time of supply. So when does VAT becomes due? Because I think back then I actually do have an issue with this because I was actually looking at it from the angle of a cash basis. So I was like, okay, I know we have actually made some sales on some certain items, but we have actually not received cash on these items, or the payment has actually not hit our bank. So do I really need to recognize this transaction for the purpose of VAT? So, but this is clear now. So VAT is due on taxable supply at the earliest of any of these following instances. So when you issue an invoice or receipt to a customer, that means the VAT has actually been what VAT has actually like applied to or has actually occurred at that point. When the goods are delivered or the services are made. So take for instance, when we sell our cars to governments, B2G or B2C, whichever one, in as much as we have actually raised invoices or we have received cash, then we, by law, you should account for what? VAT. Then let's assume you have actually not raised an invoice or receipt, but the goods has been delivered to the consumer. Then that means now we're actually talking about a change of what's control. So now once the control has been moved from the seller to the buyer or has been enjoyed in terms of service, even those invoices has not been raised, then it's proper for you to what recognize what VAT at that point. Then the third option here is when payment is due, even if the customer has not yet been paid. So, for instance, you already raised an invoice, or you know that the payment based on the agreement, the payment should be due as at this month's end. Even though you have received cash or not, it's expected for you to what recognize VAT. So when I say recognize VAT, I mean what? The filing of what? VAT as at that period of time. And of course, date payment is received. So this one can also be used. So it's more of like you're actually basing it on a more of a cash basis. But the law says that whichever one occurs first. So in my own opinion, most of the times, the invoice will always be raised whenever you are making sales. That one definitely will occur first, or the goods are delivered. So whichever one of these two definitely will occur first, irrespective of where cash has been received or not. So these are some of the items or checklists you need to have or probably check off to know at what point you should be filing your VAT for the period. So not when until you receive cash flow before you are actually like required to what do that. Then aside from that, we also have some special cases. So now, you know, the one we just discussed relates to business to business or business to government, in as much as you are not connected or related party. So now the situation also now becomes somehow technical and complicated when you are dealing with related parties. So in related parties, in the sense that you both companies are connected or probably being owned by same entity. So in this case, obviously, there might be a situation whereby the payments might never be made, invoices might or should or will never be raised, and all those conditions we listed on that first slide might not arrive. So what are the key items you need to like check, or what are the triggers for you to know when to like account for that in this instance? So for connected persons, when it comes to goods, so when the goods has been supplied or moved, so in this case, take for instance, company A is a subsidiary to company B, and company B is in Lagos, is in Abuja, and company A is in Lagos. So at the point of company A probably transporting or we billing those laptops to company B in Abuja, that means the goods has been what supplied or moved. At that point, the parent company in Lagos send a computer to so in this case, where invoice has been given or invoice has not been given in this case, should I know that invoice will not be given, you should what account for that. So for still unconnected person, when it has to do with services, so you that will be triggered at the point of what when the service begin. So also probably taking a consulting firm, giving probably a subsidiary a free audit and assurance services. So immediately that audit commences, then the VAT is what's triggered. Then connected person non-physical rights. So that also has to do with an intangible license and the rest. So when the right becomes what's available for you, probably 650, you have a QuickBooks and you are actually extending it to your subsidiary. So at that point, the subsidiary is actually having access to use such licenses or software. VAT has been triggered. Then rental and periodic and supply. So there's some agreements that might, on the general look, is a one whole service, like probably construction of building, but this is had this the milestone or the payment is actually being broken down upon each level of completions. So probably for first of all laying the blocks, or probably at some certain point you make some payments, but you don't wait till when the whole building is completed before you start making all total payments. So now in this case, now how do you not treat VAT? So VAT is not treated or is being triggered at the point each of those threshold or milestone has been what achieved. So if you achieve milestone one in probably from January to May, then you account for VAT on that portion that has been achieved. Then subsequently. So these are some of the special cases which I think it's also very important we also need to know. Then value of taxable supplies. So now, as a company making sales, so what is the value of your taxable supplies in this case? So in essence, when you are actually making supplies in terms of monetary sense, it should be the actual price of the goods plus the VAT on it. So that should be what will be on your invoices, not just when you issue an invoice with just only the price of your services without adding what VAT to it. Then when it comes to a service or a supply that is non-monetary consideration, then the market value will preside on in this case. So what is the market value of this service or goods? That's what we're going to use in measuring it for calculation and as well as remittance of the VAT. So we also have sometimes when we have a mixed consideration whereby I think this is always this is actually common with the tax and accounting services whereby you have probably an audit and assurance invoice. You also have other refundable charges on it. So on the invoice, you see it's clearly stated audited financial statement for the so year 20,000, refundable disbursement 10,000. So you see VAT apply at that first one, then the second one is not what VAT applicable. So all these things are what we need to actually like put into consideration while assessing the value of our taxable services that should be included on our invoices. So for the imported services, this is also a very, very key aspect for companies that are into importation of goods for resales in Nigeria. So because at the end of the day, you need to actually know your actual value of your input VAT as well as your what output VAT. So this one will go a long way in understanding your what input VAT, because it includes all values excluding VAT and service charge in Nigeria. So now when you are importing to Nigeria, you have some certain charges like custom duties, excess commissions, transport, insurance, all those costs that you must have actually incurred to like bring that goods into a sellable conditions should be what added to your invoice to calculate your input VAT for that specific goods. Then VAT restrictions and the registration. So this is another aspect I think we also need to know as we transact or carry out activities that relates to VAT. So essentially, as a business, when you are registering your business with CAC, I think the next wise thing you need to do is also to do a tax regularization with all relevant tax authorities, in this case, and the Federal Revenue Service, as well as the relevant and state internal revenue services. Essentially, for you to be able to have a team, as well as for you to be able to be registered with the FRS for VAT cases, as well as other tax compliances. So this is very important, and all businesses needs to know this, and also what try to also comply with it. Also, when a business is also probably a season operation, it's also expected of them to also notify the FRS within 90 days of season business operation. So that the FRS will also, from their end, update their tax promise as well as their tax records to make sure that on subsequent basis, they won't bug you with a monthly injection of VAT on your tax promise and the likes. So aside from this, we also have some special cases whereby government agencies, military departments and agencies, and are also expected to register as a VAT collection agent, as well as other companies which are also expected to register for VAT collection agents. In this case, you have some of those financial institutions like banks. They also expected to register with FRS for that. So essentially, now we might just see this as probably a burden in terms of registration, but it also comes with a benefit in the sense that so when you register with the FRS, you have what we call a VAT letter. So this is also mandatory for government contracts. So for those bidding for government contracts, you see them. If you don't have before, running heter-skelter to like quickly find a way to like quickly get that letter for them to like obtain that contract and the rest. So it's very, very important, because as it is now, we dealing with government agencies for businesses and the rest, you have these are very key items, and I think we all need to like at least know them beforehand. Then VAT returns, remittance, and refunds. So essentially, this has to do with filing. So we all know that filing should be done on or before 21st of the month preceding when all those vatable supplies has been made. So take for instance, we are currently in August. We are currently in August, so all services and supplies made, vatable supplies made in July should be remitted on or before 21st July, 21st August this month. So failure to do this, you have your own and these penalties also attached to that. So remittance, what do you remit to government? So essentially, we have what we call the input VAT as well as the output VAT. So the difference between the input VAT and the output VAT determines what you are going to do next. So essentially, the output VAT. Okay, let me start with the input VAT. So the input VAT are VAT that were suffered by you, VAT suffered by you from purchases of your raw materials in production of goods and services you sell. Then the output VAT are VAT you collect from sales of your services and goods. So when you minus the two, when you have the output VAT more than the input VAT, then you have to that is what we call VAT payable. That means you have to remit to government. Then when you have the input VAT, that means the one you suffered at the point of you purchasing your raw materials higher than the one you actually got or collected at the point of you selling your finished goods or services. Then you have, in this case, we have what we call refund. So in this case, government have two options. FRS have two options, either to refund you the money or you are going to utilize it on subsequent filing. But mind you, if you go and meet FRS and tell them to refund you the cash, you know that you are going to have a kind of a small desk review or something, because they will not just give you that way. They will first of all try to make sure that all what you have been doing so far has been actually clean and good before they can give you. So most of the times when you make such statements, then just be expecting a kind of a desk review or something before such a request will be granted. Then there's other aspects we also need to be very, very familiar with, which is the tax invoice. So essentially, the tax invoice is also your what invoice, but it should have some key elements or characteristic. So now, for instance, the companies that are supplying the name, the address, the TIN, VAT registration number, purchaser name, that means the person you're rendering the services to or you are making the supplies to, the address and TIN, date of supply, description, value, as well as VAT charge. So all tax invoice shall be issued or supply whether or not payment is made at the time of supply. So while you have actually made the payment or not, we are expected for you to raise an invoice and as well as attach it to the goods you have actually supply or rendered. So now eligibility to render VAT returns. So does that mean that everybody in Nigeria, all companies in Nigeria are expected to remit VAT or render VAT return on a monthly basis? So based on the existing tax law, there's a threshold. So when your expected turnover for a year is below 25 million, then means you are actually not actually eligible or obligated to remit VAT. But this is the catch. Most of the times you might start January very slowly, February very slowly, but there's a high possibility before December you might actually meet up with the threshold. So that's why we say a taxable person who in the course of business has made or expects to make a taxable supply with a value of 25 million or more in any calendar year, which under this current tax law, or 50 million if we're actually looking at the Nigeria Tax Act, which might actually take effect from 2026, shall render to the service on or before the 21st day of the month in which this threshold is achieved. So at the point of you achieving that threshold, you should start accounting for your VAT. And subsequently, you should on a monthly basis also be compliant with the VAT filing requirements. Okay. So allowable and non-allowable input VAT. So now currently, if we're actually speaking from the point of the current Tax Act, which is on board, then there are some certain payments or costs you incur that are actually you can actually claim input VAT on. Whereas there are also some services or costs you incur which are not allowable. So any costs that is not directly related to the production of what is sell or in determining the value of sales is actually out of it as it stands now currently. So that means by implication, goods purchased / imported for resales, those are the things you can currently claim input VAT on, as well as goods used as stock in trade or for production. So for other items like salaries and wages or any other unrestricted expenses, which we can easily expense through the normal P&L of financial statement or capital asset items, cannot be claimed as per input VAT as it stands today. Pending when we start implementing the Nigeria Tax Act, which should be sometime next year. Then offenses and penalties. So of course, there's definitely offense and penalties for non-compliance, and this is what actually scares me the most in this whole stuff. I can tell you, I'm not even too scared of. I'm actually not too scared of not being too compliant with withholding tax. Even to a very large extent, I might not even be scared of company income tax. But you see, this value-added tax is mad, because the fourth failure to even register with the FRS has its own fund. The first month is 550K. Then subsequent months is 25K. That means you already register your company with the CAC, you already started business, but just that ignorance aspect of you not knowing that you need to like register with what the relevant tax authority for VAT will cost you this amount. So failure to file returns, like I said before, monthly return is being filed on or before 21st of every month. So when you also fail to do this, you are going to suffer for the first month of default 50K, then subsequent month 25K. This is just for just that month. So if you also fail for the next month, you also have this similar penalties and fines on it. So it's actually scaring. Then this alone is not even speaking to the fact that you also have an interest and penalty sitting in one place for it also what pay on the tax payable or VAT payable when the time comes. And that one is being calculated on a daily basis. So it's actually scaring. So if there's any compliance you want to miss out on, not VAT is actually scaring with VAT. Then anticipated and changes under the Nigeria Tax Act effective 2026. So basically, what are we expecting? What are the major changes when it comes to value-added tax? So expanded input VAT deduction. So now, like I told you before, now on those previous slides we just passed, that currently you are only restricted to input VAT on those items directly relating to what productions. But the current VAT, when this Nigeria Tax Act comes on board, input VAT will not be limited to purchase of goods for resales or manufacturing according to section 156, subsection 5 under the chapter 6 of Nigeria Tax Act. So now this is what it states. Input tax incurred by a registered person on any taxable supply, including services and fixed assets made to such person, may be deducted from the tax payable by the person on its taxable supplies at the end of the tax period in which the supply occurred, but only to the extent that the input tax was incurred for the purpose of consumption, use, or supply in the course of making taxable supply. So now they have actually removed that restriction now. So in as much as the expenditure relates to creation of that profit, now I think you can actually charge input VAT on it. Of course, that will also have the aspect of the e-invoicing concept coming on board, whereby a time will come for all the expenses and inflows must actually be matched to your the MBS platform. So for verification as well as authentication. So that means any expenses or incomes that you can match, or any expenses that you have actually not be able to upload, or that is not being under the cloud of MBS, that is the e-invoice platform, you might not be able to utilize such expenses when it comes to claiming of VAT input. So it's very important. But currently, I think they are just on the first phase of the large companies. So after the large companies, then I think every other companies will also be expected to start compliance with the e-invoicing policies and the likes. So then reclassification of zero rates and VAT exempt. So this is another major aspect. I think some changes have actually occurred. Then there has actually been a major shift in the classification of supplies under the new tax law, particularly affecting items that were previously zero rates or VAT exempt. In addition, several new categories of supplies has been introduced. So now, how we're going to look at this? I want us to look at this reclassification and how it affects the company, how it affects companies as well as organizations. So the first one we're going to be looking at is items that have been moved from exempt to zero rated. So when we say exempt, we mean that these items are totally exempted from VAT. So you don't pay input VAT, you don't pay output VAT on them. Then you also have some. You also have zero-rated goods, whereby you incurred input VAT when making such products or services, but you don't charge output VAT on it at that point. So this is also a special case whereby you can actually go back and reclaim those input VAT suffered. It's essentially still very okay. It's much better than the exempt because there's no input VAT, there's no output VAT, unlike the zero rated. Then we're also going to look at it from the items that have been moved from zero rated to exempt, then the newly introduced items under the new tax act. Then starting with the first one, items that have been moved from exempt to zero rated. So basic foods. In the old tax law, it was what tax exempt. So now we are looking, if we're now looking at the new classification under the Nigeria Tax Act, it has been what reclassified as what zero rated. Essentially, what it means is now that input VAT now recoverable. That means when you those input VAT you suffered cannot be what recovered back. That is the implication now, which is actually a very good one. So we should all go back and try and check our lines of products, as well as matching them with how it has been reclassified under the new tax act, and the possible implications or impacts on our businesses. Then when you look at the likes of medical and pharmaceutical products, education, books/materials, fertilizers and local produce agricultural items, medical services, tuition, all exports, farming, machinery and equipment, all this has been reclassified from exempted goods to what zero rated. So now what it means is that they now have the ability to claim back their inputs and VAT suffered. So which is actually a very good thing. Then items that have actually been moved from zero rated to exempt. So that means the other side of it. You have the oil and gas exports, and previously within the zero rated. Then you also have goods for humanitarian donor funded projects, goods and services to diplomats, and all items under free trade zones or supply under free trade zones. They are all now what's moved from zero rated to what's tax exempt. So by implication, what it means is that if you are actually selling your goods, if you're actually making goods or services to this, you might end up not able to recover back your input VAT. All those original input VAT you must have actually suffered at the point of actually creating or producing these and those services. So these are impacts on businesses. So we also want to go back and check how does this actually impact us, and how can we re-strategize and make it more favorable for all of us. Then these are other items that have actually been moved into the new tax act. So they're actually much. So you have some as per zero rated as well as exempted. Then so key takeaway in terms of this reclassification. So the biggest winners are agriculture, education, healthcare, and renewable energies in terms of all those electric cars sectors. They now enjoy zero rating, meaning VAT refund are possible. Then the biggest losers are oil and gas exporters and humanitarians and diplomats, which might not be able to recover or claim back their input VAT that were previously suffered. So we need to go back and probably reclassify some of our suppliers, or probably see how we can actually treat them more better, that we still to some extent be within the tax law and also still benefit us, which has to do with the tax planning, of course. So the practical steps for VAT compliance. So basically, we all in this place today might have interest in working with companies, or we're currently working with company or consulting firms, and we might be in the positions to responsible for filing of VAT or dealing with matters that relates to VAT. So the first thing we need to do is to basically understand our clients or the organization sales and revenue structure first. That is the first thing. So when I got to CID, the first thing I did was to know the goods. First of all, we have some set of goods for electronic vehicles, which are actually VAT exempt. Then we also have the normal petrol vehicles. So I try as much as possible to see all those kind of sales and the nature of the sales, the products, as well as how it's tied down to vatable goods and services. Then the next thing is always make sure on or before 10th of every month, you are able to collate all sales invoices and other relevant ledgers or documents across all board in your organizations, and for you to start making your VAT extractions or computation on. So it's very essential because don't forget we have a deadline as per 21st of every month. So you must at least collate all this information because there are some organizations that are actually well structured that you need to like go across several departments to get all these documents. The earlier you start, the better. Then step 3, basically just compute your VAT position by calculating output VAT on sales and input VAT on purchase to determine whether there's a net VAT payable or refundable for the period. So once this one is done, so the next thing you do is before you go to TaxPro and start filing, then you do your normal review because it's very essential. It's essential for you to do review with the relevant line managers and the likes. Then I think the filing of VAT returns on TaxPro should be the last step. Then the filing deadline. So like I said before, you have the regular VAT returns, which is being done on before 21st. Then you also have what we call withholding VAT returns. So I actually speak to this, which I'm going to speak to shortly. Invoices. So that means when a CIG Motors supplies some fleet of cars to probably Lagos State, so it's expected of Lagos State to withhold the VAT on CIG invoice and remit on behalf of CIG, then paying to CIG just what the value of the car, sales value of the car. So they don't need to pay back to CIG the value of the car as well as the VAT on it. They are just paying back what the value of the car, then withholding the VAT on it as per law to remit to the federal FRS. Then aside from this, other entities or industries that are actually like obligated to do this are those under financial institutions like the banks. So whenever you also do businesses with them, they're also mandated by FRS to withhold VAT from the suppliers and invoices and also remit on behalf of them. So when did you do this? So let's assume your organization is part of those entities or ministries or parasites that are expected to what withhold on VAT. So you must also know that you have a deadline of on or before 14th of every month. So which is much earlier than the normal VAT returns in on 21st of every month. Then the other concept that also comes to my mind is the self. So where you receive an invoice from a supplier, and on this invoice, the supplier only what stated what the value of the service or the supply without VAT on it. So the law states that you are expected to what do a self account on it. By implication, you are going to calculate the VAT element on that invoice and remit to what in the Federal Inland Revenue Service. So that is the concept of what self accounts in VAT. Also, it also relates to those non-resident entities when they sell to you, or um, when they are into any business with you, probably services or supplies. So, they are not permanent in Nigeria, they are not resident in Nigeria. So such sales now is you are going to what self account on those invoices you receive from them. In essence, wherever you are receiving, whenever you are paying them, that means you are going to what do the percentage of that VAT, hold it, withhold it, then remit the sales to them, then you remit to government, and that also form the final tax, because they're actually not really resident in Nigeria. So that form the final tax burden on those individuals. So what's next? So let's quickly check out tax promise and see what we can quickly do on it, and a walk through the tax promise and see. Uh, Sorry, I don't know if anyone can still hear me, or